Hello, this is Megan Horneman, the Chief Investment Officer for Verdence Capital Advisors, and coming to you today with our Markets with Megan. We're following up with the podcast that we did yesterday, which was the prelude to the jobs report. And this morning we got the official jobs report, and it was a little bit more reflective of some of the weakness that we've seen in other labor market indicators like small business optimism or manufacturing. The jobs report came out with the addition of 209,000 jobs, so it was a little bit less than expected and a lot less than that ADP report we got yesterday. But let's break this down and get through some of the details. When you look at the prior 2 months, those payrolls were actually revised down by 110,000. So just on that surface here, this is an actual weaker job report. But what the Fed's going to look at is the fact that the unemployment rate dipped lower again. You also saw that average hourly earnings, which is an inflation indicator, they were up 0.4, and now they're rising about over 4% on a year-over-year basis. And this has been a consistent thing every month that they're growing about 4.4% on an annual basis. So we think what you're going to see is that the Federal Reserve's going to have to raise rates in July. They may deliver, again, some very same kind of sentiment as where they'll be data dependent, because underneath of some of the things in this jobs report, we did see some further weakness. If it's whether the temporary workers that fell, so remember you'll lay off temporary workers before you lay off full-time workers. And then as I mentioned, that downward revision to the prior 2 months, that's a soft report there. So the Fed's going to probably have to still go in July. That hasn't changed. And we'll see what we get as far as some of the inflation indicators, but to get a better idea of what they'll have to do in September. But for the time being, the equity markets are kind of directionless on this news because there was a little bit in this report for the bears and a little bit for the bulls. We still think we'll see further weakness in the labor market for the rest of this year, make it kind of unavoidable that we'll have a recession at some point over the next 12 months. That's all I have today. If you have any questions or comments, please feel free to reach out to podcast@verdence.com. Thank you.